Hello, ladies and gentlemen of YouTube. Today I'd like to talk to you about how you can make money by writing call options. These are also known as short calls. Typically, people are more familiar with buying call options or buying put options, and those are pretty simple. If you buy a call option and the price goes above your strike price, that means you're in the money and you start to make money back on how much you paid for your call option. Conversely, if you bought a put option, if the price goes below the strike price, you start to make money back from what you paid to buy a put option. If you sell a call option, this is kind of what I like to think of as making your own dividends from shares that you hold while not actually receiving dividends. And let me explain. As you can see here, this chart here, this shows how much profit you'll make when you sell a call option. So the payoff amount is fixed. You're going to make a fixed profit when you write your call option, and you only start to lose money on your call option if you write it if it goes above a certain price. So when the shares go above the strike price, you start to lose your profit, and there becomes a point where you would have been better off if you didn't write this call option. And let me talk about a covered call option. A covered call option is when you actually own shares of the company that you're doing the short call for. And the good thing about a covered call option short is that you won't actually lose money. You're just going to be forced to sell shares at the strike price. And this is kind of what I like to do when shares seem a little bit expensive in my portfolio. I like to write call options and make money immediately from those shares. And I usually write the strike price to be a price that I would definitely be willing to sell these shares for. Sometimes it backfires when shares just go through the roof, but normally it's just a steady way to make profit off the shares you already have. And let me go ahead and show an example of what I think might not be a bad idea. If you're holding shares of INO today, June 25th, 2020, today the share price for INO went up 30%, and the options also went up. I can actually write a call option that expires August 7th for $30. That means I'm willing to sell my shares for $30 per share because they've gone up so much. And I'll be able to make $11 from writing these shares. And I say 11 because that's between the bid and asking price. And I really never put market orders when I write options. I actually enter them in. So, for example, I would do 11 right here because somebody's willing to sell it for $11.20. Somebody's willing to buy it for $9.50. There are usually people that meet in the middle and will just snatch up anything in between. So, put your limit order between these two, and then you'll make more money when you write these options. Now, if I do this, I will immediately make $1,100 into my portfolio. And if I'm covering this short call option, then I will only be forced to sell these shares at $30 per share if they're $30 per share by August 7th. And since they've already gone up so much, 30% today, it's effectively the same as me selling the shares. Because right now it's $31. It's me selling the shares for $41 per share, which is much higher than the current price. But I'm saying I'm going to sell these shares for $41 per share on August 7th. That's exactly what I'm doing here. And then if you go into the profit loss chart, I'm using Charles Schwab. If you go into the profit loss chart, you'll see that your profit at expiration will be $1,100. But if the share price starts to go up, then your profit goes down. It seems like an amazing price for an option because people think that this stock is going to go up even higher. That's why there's such a huge premium on this option. So much so that the profit loss chart doesn't even go to where you wouldn't make a profit. But if I follow the line down it looks like 36, 37, 30, probably around $38 per share is where the break-even point will be. Oh, wait a second. I can use math to figure it out. Oops. So 30 plus 11 would be $41. So, okay. $41 is the break-even point for this. If it goes above $41, I better not have wrote this call option. If it stays below $41, then I'm okay. I'm okay selling the shares for $30 per share because I made $11 off of this option. Sorry, this has kind of been long-winded, but it's important that you wrap your mind around this because I think I started doing this around, well, it was 10 years ago. And for me, it was awesome because what I would do is I would hold oil ultras and I would write call options for these oil ultras and just keep making bank because people put a high premium on volatile stocks and ETFs, and oil ultras are pretty volatile. So what would happen was I keep my UCO, and that was the share that I was playing with, and I keep making money from writing options. And the further out you go, the more money you're going to make. So let's just say you bought INO, let's just say you bought it in March. Then you probably let's just say you don't want to spend too much in capital gains. So you would want to choose a date in the future. It looks like here I can choose February 2021. That's too early, so I'm going to have to choose January 2022, which is a ways off. And let's just say I'm willing to sell these shares for... And I'm going to go up in price because I want to make time value of money on what I'm holding. So I'll say, okay, I'll be willing to sell it for $35 per share in January. Ooh, I made even more money because I'm giving those option holders more time to change the price. So I'd be able to get $15 immediately just for holding my shares until 2022. January 21st, 2022. So that's, and I need to change my limit price here to be 15. And yeah, $1,500. And the value of my shares is $3,100. So you're almost making 50% profit just by writing an option and being willing to hold those shares until that time. And so the profit is actually going to be more than this if the share price goes up, because you're going to be able to sell it for $35 per share. So what that ends up being is $50. You're making $50 per share just by having this, and this only costs $30 per share right now. So you could literally buy INO right now and then write covered call option for $35 per share that expires January 2022. And you'll be making $50 per share if it goes up. If it goes down, that's the flip side there. If it goes down, this is guaranteed. You're going to make $1,500 and you're not going to be forced to sell your shares. However, the shares could decrease in value to, let's just say, it could go back down to $10 per share. Or even $7 per share. That's the price I bought it for. So do your research on these guys. If you feel more comfortable buying stocks that are more staples, I guess, like Microsoft, you can do that as well. You just have to, let's just see. So Microsoft is currently trading for $200 per share. Let's just say you had some shares of Microsoft and you want to make money off of those shares. And you would be willing to wait and hold these shares until, let's just say, the end of this year, so December 2020. And you're willing to make a measly $10 per share off of your Microsoft holdings. Okay? The limit, you see the price for this option is $14 per share. And that's very similar to INO, which, like I was saying, INO options right now are so expensive. I think it probably has to do with a lot of speculators trading on Robinhood, Charles Schwab, whatever, because Microsoft is so much more valuable than Inovio Pharmaceuticals, but you up the price by only $10 on a $200 share, and the option only gives you $14. So that's like I'm saying, volatile companies have a higher premium on their options, especially their call options. So if I'd be willing to sell Microsoft for $210 per share in December, I could do this, and I would just write down. I would do probably 1380. That would probably go through. And I could look at my profit loss chart. And you can see that, off the bat, my profit is 1380. But if the price of Microsoft goes to, 223 or so, then I would start losing money off of this option. But if I had shares of the company, then I don't lose money. I'd be forced to sell. I'd be forced to sell Microsoft at the strike price, which is $210 per share. And in the meantime, I still get quarterly dividends from Microsoft, and I can choose to reinvest them. I hope this has been helpful to sort of see kind of firsthand how you can make money by writing covered call options. I don't really want to show my whole portfolio, but it is. It's definitely a good way to make consistent money, and the only risk that you have is selling your shares for a profit. For me, because I always write my covered calls at a price that's higher than the current trading price. That way I don't feel as bad if the stock goes up tremendously, because at least I'll be making money off of the option and the underlying stock. Next video, I'll plan on talking about how you can write put options to buy stocks at a discount. So stay tuned and subscribe to my YouTube channel, The Highest Return Investments, and I will be giving that to you. If you have any questions, please write it in the comments. I learned from your comments, and if anything's confusing, I'd like to know, because this whole thing is sort of confusing. But as Robinhood has opened the trading to the masses, I think it's important that this information be available in an informal setting to a random viewer like you on YouTube. I don't think it should just be people in suits at Wall Street trading in New York. I think it can be someone like me, in my little office here on my small YouTube channel. So subscribe, like, comment, and have a great day.